1,870,000.
The 200,000 should be negative.
The land,
For Tucker. Long-term debt, Tucker. She's looking at Marshall right now.
oh, minus 200. So that one balances. I'm off here 400,000.
Is it the investment?
Oh God. Thank you. That's going to be a journal entry. No, but we should have an no, we don't have an investment in Tucker. So I need to look at this stuff. You're right. So now what we're going to do is we need to figure out what the book value, 400,000 fair value, book value, assets minus liabilities, or total stockholders' equity. So basically here, we have the book value of 400,000 minus the book value, assets minus liabilities, or stockholders' equity. So if we take the book value of our assets minus liabilities, so we've got here 700,000 minus the 240. Do you see what I'm saying? Book value, assets minus liabilities, or stockholders' equity. So that should be the 700,000 minus the 240 gives us what? 460. 7 minus this is 460,000. So we need to figure out here, we have the consideration, 400,000, less the book value of the net assets. You know what I mean by that. It's 460. So the book value in excess of the consideration transferred is 60,000. So that's 60,000 here. Okay? Minus 60. Then we show the fair market values. We have inventory of 5. We have land of 20. We have the buildings of 30, which is, we're going to add to that book value 55,000. Do you see what I'm saying? So this is how we're going to allocate our gain. So we need to show the inventory at 5,000 more. We need to show our land up 20 and our building up 30. So we're going to need to record journal entries to adjust those. Does that make sense? So let's look at this. We're going to need to show that the inventory increased 5,000, right? What else went up? The equipment. The land went up 20, the building went up 30. The land went up 20. The building went up 30. Does that make sense? Yes? No? So far, our cash is just going to be the two book values combined. Our accounts receivable is going to be the two book values combined. The inventory is going to result from the 360 plus the 140 minus the 5,000. No, excuse me, plus the 5,000. The equipment is going to be the summation of the equipment. The buildings will be all added, and so will the land. So we have total assets here of $2,895,000, I believe. Let's make sure my numbers are right. Okay. Then we have the accounts payable is going to be the combination. The long-term debt is the combination. We're going to want to wipe out the stockholders' equity section, and we're also going to want to wipe out our investment in Tucker. Or excuse me, we don't have an investment in Tucker yet. That's our problem. There is no investment. The first problem showed an investment in Tucker. So how are we basically going to do this? Our total assets should be cash of,
First, one question on your bill and your equipment.
yes,
Is 160 plus 50 supposed to be 880?
no. I've got my numbers goofy here, don't I? So I'm going to basically do, let me just do this. I'm sorry, guys. Equals this plus this minus the credits. Then if I take that and I bring it down, we should balance. Let's see if that's right. No, it's not right yet because we need to probably do another adjustment. Now our accounts payable is going to be equal to this plus this minus a debit plus a credit. See what I'm... That right so far? Now we've got some journal entries to do. So we have this transaction when we created our journal entry. Where is it? I thought we had the journal entry here. The investment in Tucker. Long-term investment in Tucker, $515. Then we have our long-term liabilities, our common stock, additional paid-in capital, and gain on bargain purchase. We have our legal and professional fees and additional paid-in capital, correct? That we need to adjust for. So basically we show here the cash account for Marshall should be our 80 minus our 30 minus our 12. See what I'm saying? 80 minus the 30 minus the 12. That's all we paid in, right? So 80 minus the 30 minus the 12, what would we end up with cash? 60, 80, 30, and 12. Let me figure out what I'm doing wrong. We need to have the book values of both less the acquisition and stock issue costs. So we started this at 60, but if we take into account the 30,000 in fees, that brings it down to 30, okay? The 12,000 in stock issue fees, then what this will be is the 60 minus the 30 minus the 12,000 or 18,000. Okay? The accounts receivable will be just the combination of 360. The inventory is going to be both book values plus the increase in fair value, or 505. We now have an investment in Tucker on our books of $515,000, don't we? Then we have equipment of $210,000. Our buildings, we show our initial book values plus the fair value increase. We've got land, which is the $200,000 plus the book value of the company we're buying plus the increased fair market value. The buildings, we've got, right, equipment, building 670. The equipment, we've just added the two together, 210. Our total assets should be a combination of the cash, 38, the receivables, 360, the inventory, 505, the land, 400,000. If I get rid of this investment in Tucker right now, that's what's screwing me up. Okay, let me get rid of that investment in Tucker. So I've got my assets right, $2,183,000. Then, if we look at our accounts payable, we're adding the two. Our long-term debt is the 430 plus the 200 plus the debt that incurred by the parent in acquiring the subsidiary. Remember how we added some debt in acquiring this subsidiary? So basically, in acquiring it, we added another 200, or 630. The common stock is 130 here. Why is it instead of 110, 130? Because remember the par value over here was an additional 20,000. So we're going to add 20,000 here. Then we've got 130. The parent book value after stock is issued to acquire the subsidiary, because we are not going to take into account the common stock of the parent company. What am I doing wrong there? D17 plus C17 plus D17. Okay, now our additional paid in capital should be our 360. And we need to also take into account, what did we add to our additional paid in capital to acquire the company? If we look over here, the additional paid in capital to acquire the company was 180. Okay, so the additional paid in capital to acquire the company was 180 minus, what were the stock issue costs? I promise I'm not going to give you a problem like this. Minus the 180 plus the, what were the stock issue costs, guys? 12,000? So 528. And then the retained earnings is only going to be the section from the parent company, which is the 404 plus the income of the expenses. So basically, our retained earnings section is going to be, we started with 420, and what did we, verify the answers, prepare a worksheet. So basically, The retained earnings, we started with